Chapter 9, Part 2, we're going to cover transfer pricing and cash conversion. So first we're going to look at transfer pricing, and this is what happens when two divisions want to do business with each other. How do you determine the amount that they charge? So what we have to look at is what is the variable cost versus what they can sell it for, because this is called the negotiation range. Okay, so the department that has the goods doesn't want to sell below their variable cost per unit, and the division that wants to buy the goods doesn't want to pay more than they would pay out in the marketplace. So again, transfer pricing is the price charged for the internal sales of products between two different divisions of the same company. Becomes sales revenue to the selling division, becomes a cost to the buying division. These were also known as intercompany transactions. We talk a lot about this in advanced accounting. It affects the operating income, return on investment, sales margin, and residual income. To optimize overall profitability by encouraging a transfer price only if the company would benefit from the exchange. Now, there are three ways that this can be done. First is we can use the market price. You'd use this if they can sell everything that they can make and the facility is at capacity. So there's no benefit for them to charge less than the selling price. So they would sell whatever, they sell it to the market. Negotiation is they're selling to the outside, but the range is going to be between the variable cost per unit and what they can sell it to the outside. And this would happen if the one selling the goods is not at capacity or not selling all the goods they produce. And then cost or cost plus market would be for a division that doesn't sell to the outside. They're part of a process. Okay? And again, this would be negotiated between the variable cost and absorption cost. So again, negotiated is only used if sales are not at capacity of the division that's selling the goods. So let's take a look at an example. The box division makes metal boxes that have multiple purposes. The boxes have a market price of $50 and the variable cost per box is $8. The division has a capacity of 75,000 boxes per year at a fixed cost of $450,000 per year. What is the negotiable range? Well, it's between the variable cost and the selling price. What if another division wants to buy 20,000 boxes? The box division is at capacity and can sell all the boxes they make. What price should they sell them to the other division? They couldn't sell them for less than $50 because that's what they can make on the outside. So that would have to be the price they use. Now, what if instead the division wants 20,000 boxes and the box division normally only sells 50,000 boxes, which means they're not at capacity? What price should they sell for the other division? Well, that's where they negotiate. They have to sell between $8 and $50. The box division will not accept less than $8, and the purchasing division will not pay more than $50. Now let's look at the number of days in the cash conversion cycle. Now, lean manufacturers try to reduce the time from paying for raw materials, which is the cash outflow, to collecting on credit sales from customers, which is the cash inflow. Cash conversion measures is based on accounts receivable, accounts payable, and inventory, and they're used to evaluate each of these separate dimensions. These measures can be combined to show how a company manages its working capital. The cash conversion cycle or cash-to-cash cycle measures the average time it takes to convert cash outflows into cash inflows. So, here we go. This is our formula. It's days sales and accounts receivable plus days sales and inventory minus days payable outstanding. And here are our formulas, which we're going to use to come up with this calculation. So you need to know these three formulas before you can do it. And it's always going to be times 365 days. So here we have an example. We have all the information we need. And the first thing, in order for us to do the cash conversion, first thing we have to do is calculate the days sales and accounts receivable. So we're going to take accounts receivable divided by net sales times 365 tells us we have average of 28 days. Is that good or bad? Depends on what the terms are. If their terms are net 30, they're doing fine. If their terms are net 10, they're not doing very good, are they? So you need to know more information when you look at that number. Now, calculate days sales and inventory. We're going to take our inventory divided by cost of goods sold. In that case, we have 13 days. Then we're going to calculate the days payable outstanding. We're going to take our accounts payable divided by cost of goods sold, and we get 24 days. Now we can come up with our cash conversion. How long does it take us? So we're going to take the 28 days plus the 13 days minus the 24 days, and on average it takes us 17 days to convert what we spend to get our money back. So if their competitor has a cash conversion of 20 days, who is more efficient in managing their money? Company A is, because their cash-to-cash cycle is less. Ours is only 17 days. And that ends Chapter 9.